If you are over age 60 or already collecting Social Security, you've probably heard that your check is changing in 2026. But what most people don't realize is that some of these changes could put more money in your pocket, while others could quietly take money away without you ever seeing it coming. So, stay with me, because before this video is over, I'm going to walk you through all 7 changes, explain what they really mean in plain English, and show you exactly what actions you can take to protect your retirement income. Most people hear about a higher cost of living adjustment and assume they're getting ahead. But behind that increase are hidden tax traps, rising Medicare costs, earnings limits, and aggressive new overpayment clawbacks that could dramatically reduce what actually reaches your bank account. Today, we're pulling back the curtain. We're not chasing riches. We're protecting what you've spent lifetime earnings. By the end of this video, you'll know how to navigate these 7 changes and avoid costly mistakes that catch many retirees completely off guard. Before we dive into the 7 changes, let me quickly show you how we put this together. Over the past several weeks, my team and I dug through hundreds of pages of government reports, Social Security updates, Medicare guidance, and new tax provisions affecting retirees in 2026. Our goal was simple: create a clear roadmap that helps ordinary Americans protect their retirement income. But the deeper we went, the more confusing things became. We found conflicting headlines, dense federal jargon, and rules scattered across multiple agencies. One document talked about Social Security benefits, another focused on Medicare premiums, a third explained tax changes, yet almost none of them showed how these pieces interact in the real world. That's where things got interesting. Instead of relying on generic calculators, we modeled real retirement scenarios using Social Security benefits, IRA withdrawals, work income, Medicare premiums, and federal tax rules all at the same time. What we discovered were several hidden financial cliffs, including one little-known tax trap that can push a retiree's effective tax rate above 40%. And that's why this video matters. Let's walk through the 7 major changes for 2026, and more importantly, what you can do right now to protect yourself. The first change is the one you've probably already heard about, the 2.8% COLA increase. Beginning in January 2026, nearly 71 million Social Security beneficiaries will receive a 2.8% cost of living adjustment, raising the average retirement benefit from about $2,015 per month to roughly $2,071 per month. On paper, that sounds like good news. The average retiree will see an increase of about $56 per month. But here's where many people get caught off guard. Social Security doesn't simply increase everyone's check by the same dollar amount. COLA is a percentage-based formula. That means it multiplies whatever benefit you're already receiving. And that creates what I call the compound trap. If someone claimed benefits early at age 62, their monthly benefit was permanently reduced. A 2.8% increase on a smaller check produces a much smaller raise. In some cases, that increase may only be around $19 per month. Meanwhile, someone who delayed benefits until age 70 is receiving a significantly larger baseline benefit. The exact same 2.8% increase could produce nearly twice the dollar increase every month. That's why claiming decisions continue to matter long after you start receiving benefits. The gap doesn't stay the same. It widens over time because every future COLA compounds on that existing benefit amount. And stay with me, because later in this video, I'm going to show you how rising Medicare costs could absorb a large portion of that raise before it ever reaches your checking account. Now let's move to the second change. If you were born in 1959, your full retirement age in 2026 is exactly 66 years and 10 months. If you were born in 1960 or later, your full retirement age reaches the final cap of age 67. This may sound like a minor technical adjustment, but it affects thousands of dollars in lifetime benefits. Many people still believe there isn't much difference between filing a year or two early. Unfortunately, that's not how the math works. Claiming before full retirement age permanently reduces your monthly benefit. And if you're married, there's another consequence many families overlook. Survivor benefits. When one spouse passes away, the surviving spouse may inherit benefits based on the deceased worker's record. Filing early can permanently reduce the amount that surviving spouse may ultimately receive. In other words, your claiming decision doesn't just affect you, it can affect your husband or wife for the rest of their life as well. Now, if you recently filed and are already regretting the decision, there is one important exception. The Social Security Administration provides a 12-month reset window. Within 12 months of filing, you may be able to withdraw your application using Form SSA-521, repay benefits already received, and restart your benefit strategy. It's not an easy process, but for some retirees, it can be a valuable second chance. Now let's talk about something that surprises many working retirees: working while collecting Social Security. For 2026, if you are collecting benefits and have not yet reached full retirement age, your earnings limit rises to $24,480 per year, or about $2,040 per month. If your earnings exceed that amount, Social Security can withhold benefits using the rule of $1 withheld for every $2 over the limit. If you reach full retirement age during 2026, a higher limit of $65,160 applies before your FRA month arrives. But here's the most important thing to understand. Many retirees mistakenly think all income counts toward this limit. It doesn't. Wages count. Self-employment income counts. But IRA, withdrawals, pensions, dividends, interest, and capital gains do not count toward the earnings test. Understanding that distinction can help you avoid unnecessary benefit reductions and prevent unpleasant surprises from the Social Security Administration. The fourth change affects older Americans who are still working, consulting, or operating businesses. The maximum taxable wage base rises to $184,500. That means earnings up to that amount remain subject to Social Security payroll taxes. For many Americans, this won't matter, but for higher earners and self-employed professionals, it means paying more into the system during 2026. The lesson here is simple. If you're still earning substantial income in retirement, tax planning is no longer optional. Small adjustments in timing, income structure, and retirement distributions can produce meaningful savings over time. Now we arrive at what may be the most important update in this entire video. And frankly, it's the one that concerns me the most: the return of the 50% overpayment clawback. Imagine opening your mailbox and finding a notice stating that Social Security believes you were overpaid. Maybe it was caused by unreported earnings. Maybe it was a paperwork issue. Maybe it was an administrative mistake made years ago. Under the current rules, Social Security can automatically withhold up to 50% of your monthly benefit to recover that money. Think about that. For many retirees, Social Security is the foundation of their monthly budget. Losing half of that income could be devastating. That's why you need to remember something called the 30/60 rule. If you receive an overpayment notice, you generally have 30 days to file an appeal or waiver request and stop withholding from starting immediately. You generally have 60 days to formally challenge the determination. The key forms are Form SSA-561 and Form SSA-632. The moment you receive a notice, take action. Do not put it in a drawer and deal with it later, because later may be too late. Now let's return to the COLA discussion from earlier. Remember that average $56 monthly increase? Here's the problem. The standard Medicare Part B premium is increasing to approximately $202.90 per month. Since Medicare premiums are deducted directly from Social Security checks for most retirees, part of your COLA increase never actually reaches your bank account. In practical terms, a meaningful portion of that raise is immediately consumed by higher healthcare costs. That's why retirees should focus on their net income, not just the headline COLA announcement. The number that matters isn't what Social Security adds. It's what remains after Medicare, taxes, and deductions are taken out. The seventh change involves something many retirees don't discover until they're already paying more than necessary: IRMAA surcharges. If your income exceeds certain thresholds, Medicare can charge additional monthly premiums on top of your standard Part B and Part D costs. For 2026, the base thresholds begin at $109,000 for single filers and $218,000 for married couples. The frustrating part is that Medicare generally looks back 2 years when determining these surcharges. That means someone who retired recently may still be paying premiums based on their old working income. But there is a loophole many people never hear about. It's called Form SSA-44. If you've experienced a qualifying life-changing event, such as retirement, reduced work income, divorce, or the death of a spouse, you may be able to request a new determination based on your current income rather than outdated tax returns. For some retirees, that single form can save hundreds or even thousands of dollars every year. Now let's talk about the hidden threat that ties many of these changes together: the infamous Social Security Tax Torpedo. This is one of the least understood retirement risks in America. Many retirees believe that if they're in the 12% tax bracket, they pay 12% taxes. Unfortunately, that's not always true. When your provisional income exceeds certain thresholds, a growing portion of your Social Security benefits becomes taxable. For single filers, the first threshold begins at $25,000. For married couples filing jointly, it begins at $32,000. Cross higher thresholds, and up to 85% of your Social Security benefits can become taxable. Here's where the trap appears. Suppose you withdraw money from a traditional IRA. That withdrawal counts as taxable income, but it can also cause additional Social Security benefits to become taxable at the same time. Suddenly, you're paying taxes not only on the withdrawal itself, but also on benefits that were previously tax-free. That's why some retirees discover they're facing effective tax rates of 30%, 40%, or more, even though they thought they were in a much lower bracket. The good news is that there are ways to defend yourself. One opportunity comes from the new senior deduction available to qualifying taxpayers age 65 and older. Another strategy involves Roth conversions during lower income years before claiming Social Security. Because Roth withdrawals generally do not count toward provisional income calculations, they can help reduce exposure to both the tax torpedo and Medicare surcharges later in retirement. As we look ahead, there is one final issue we need to keep on our radar: the future of the Social Security Trust Fund. Current projections continue to warn of financial pressure later in the decade, and many Americans are responding by panic filing benefits early. But fear is rarely a good retirement strategy. In many cases, delaying benefits still produces the strongest long-term outcome, even under potential future reduction scenarios. At the same time, retirees need to remain alert for a growing wave of scams. We're seeing reports of AI voice cloning scams, fake government calls, and fraudulent Medicare schemes targeting older Americans. Remember this: Social Security will never call demanding gift cards, cryptocurrency, or immediate payment over the phone. Protecting your retirement isn't just about maximizing benefits. It's also about protecting yourself from those trying to steal them. Our mission on this channel is simple: help you protect what you've spent a lifetime building. If you found this breakdown helpful, please take a moment to like this video, subscribe to the channel, and share it with a friend or family member who depends on Social Security. And in the comments below, tell me this: Which of these 7 changes surprised you the most? Thank you for spending these few minutes with me.